Dani, pa concept.
1, 2, 3.
Okay. Nagloko ulit kasi kanina.
Ooh. morning. You're watching a home broadcast of BWorld Live. I'm Danny Laurel. It's 10:30 a.m. here in Manila. We're about an hour into our shortened trading day. Let's kick off with our top story. A shake-up in the government's economic team on Friday. At the height of the battle to save the economy amidst the global pandemic, Socio-Economic Planning Secretary or former Secretary now, Ernesto Pernia, quits. Now, he cited personal reasons as well as, quote, differences in developmental philosophy with some fellow cabinet members. Finance Undersecretary Carl Kendrick Chua has been appointed acting secretary of the NEDA. Pernia's exit comes as another major global institution predicts a contraction in the country's economy. S&P Global Ratings slashed its outlook on the economy to negative 2%. That is a contraction, and that is coming off of the 4.2% growth that it was predicting just last March. The debt rater also cut its growth outlook on Asia Pacific to just 0.3%. That is under an assumption that the world will enter a transition period where social distancing measures, full lockdowns, and business as usual will exist in a continuum throughout the middle of 2021. Now, they are estimating as much as $4 trillion in economic losses throughout Asia. But as for 2021, S&P sees the Philippine economy bouncing back strong with a sharp 9% growth in the aftermath of the health crisis. It's looking to be a tough opening this Monday morning as we kick off a brand new trading week. Take a look at my Bloomberg terminal here. We are trading down by 72 points, so that's around a downswing of 1 3/10% to 5717.65. Now, this follows what we saw as a major rebound last Friday amid fresh monetary stimulus. So recall that the Bangko Sentral, in an off-cycle move, cut our benchmark rate by 50 basis points. That's actually the lowest we've seen on record. And after this, policy firing or monetary policy firing, we actually saw the markets firming up by 4 8/10%. We ended just below 5790 on Friday. And this rebound, however, came after the biggest drop that our index had seen in almost a month. Now, if you take a look at on a weekly basis here, so I'll take out the 1 month chart for you guys so you can see how we had already been climbing. This actually is the fourth straight week of an increase in our stock markets. And on a weekly basis, last week we were up by 5%. And the value turnover is also firming up by 34%. So we actually had a trading turnover of around 7.65 billion pesos last week. So that was actually a good development here. Now, another thing here is that in terms of the BSP rate cuts and more monetary and also fiscal stimulus coming, analysts are saying we may see even more unscheduled rate cuts. And this also comes after BSP Governor Ben Diokno did mention that they have plenty of ammunition still left. Now, this from Capital Economics is Alex Holmes. He's looking at another 50 basis point rate cut coming on May, and that would actually bring our benchmark or the policy rate eventually to just 2%. He also is looking at another triple R cut of around 300 basis points, but he does see the economy contracting by 4% in 2020. Now, according to Nicky Mapa of ING, he's been very vocal about the fact that the BSP still has a lot of space to move. He's still seeing another 200 basis point additional cut in the triple R plus a 25 bip rate cut in the back pocket of the central bank governor. We've also got Chidu Narayanan. He is from Standard Chartered. He is also seeing a 50 basis point off-cycle cut, that before the next policy meeting, which is now on June 25th. Recall that the May 21st meeting has now been canceled, but he does see another economic contraction as well for 2020 in the Philippines, contracting by 2 3/10%. Just a quick check on our local currency here and how that reacted. We actually saw a weakening of the peso just right after the BSP had fired that barrel stimulus. But you're going to be seeing us recovering a touch. We're now trading at 50 spot 895 to the greenback. Now, according to UBP's Carlo Asuncion, apart from the BSP's rate cut, which weakened our local currency, there were also those GDP and retail figures that came out in China on Friday that basically gave an risk-off sentiment throughout emerging market currencies. Traders also saying the peso may continue to depreciate this week, especially as we assess the impact of the coronavirus. And also, we've got more news coming on whether our lockdown will be extended here in Luzon. Another worrying thing is net foreign fund outflows continuing, and that is another exodus. And this is also what's causing jitters among analysts, saying whether we will see more volatility this week. Overseas investors selling on Friday. That was the 23rd straight day, pulling out $16 million. Now, on a weekly basis, that was actually close to a 50% expansion of net foreign fund outflows. That's actually 1.24 billion pesos that we lost on average. So this is very worrying. To Trade Asia is saying that traders are still very much looking at risks. The first risk they're looking at is whether there will be a second wave of COVID-19 infections here in the Philippines, and that could lead to another ECQ in the second half of the year, plus a risk of a deeper economic fallout. Now, Mike Ricafort is echoing the same sentiment, saying that the hardest hit businesses, every time you extend a lockdown for 2 weeks, that is equivalent of about a 4% income or production loss on an annualized basis. So every 2 weeks of a lockdown, 4% loss in income there. Now, another thing we want to check in on is the sectors and how they are performing today. Recall that Friday saw a surge in property firms by 5.7% just amid the central bank cutting its rates. You can see properties now sliding back a touch, let's say paring back those gains. It's now actually trading down by 2 3/10%. We will check in on the markets later on in the broadcast. For now, moving on to other headlines. This Monday morning, both the BIR and Customs failed to hit their revenue targets for the first quarter. The Finance Department says this is due to March collections taking a hit due to the implementation of the Luzon-wide quarantine. Now, the DOF's preliminary data shows that Customs and BIR generated a combined 600 billion pesos. That's from January to the month of March. This was 20% short of the 757 billion revenue target for the first quarter and 10 billion pesos lower than the collections from the same period of last year. Now, in March, the two agencies collected around 160 billion pesos, which is 35% short of the month's almost 250 billion peso goal or target. Now, Customs Assistant Commissioner and spokesperson Vincent Paronilla explains that the main collection agency saw a downfall in revenues. That's mainly because of COVID-19 affecting port operations globally. Now, Finance Secretary Sonny Dominguez is now expecting tax collections to be a bit lower than originally targeted this year. The two agencies were tasked to collect over 3 trillion pesos this year, and that's, of course, to partially fund the 4.1 trillion peso spending plan. Meanwhile, National Treasurer Rosalia De Leon assured that the government has enough cash to fund response programs against the coronavirus outbreak from the 300 billion peso plan payment from the central bank and, of course, additional liquidity from different multilateral lenders. The Philippines is not the top choice of Japanese firms that are planning to shift production out of China. That's due to the effects of the pandemic. And this is according to the Japanese Chamber of Commerce and Industry of the Philippines. Now, the Chamber's Vice President and Executive Director, Nobuo Fuji, is saying the Philippines is not a top choice and that Japanese manufacturing firms are considering other countries. So they're looking at Vietnam, Indonesia, and Thailand first before the Philippines. Now, Fuji said that manpower resources is the best way to attract Japanese companies to the Philippines. However, the lack of supply chain and raw material production, as well as foreign companies' perceived image of the Philippines, remain to be issues. Earlier this month, Japan announced that it set aside $2.2 billion of its economic stimulus package. That's to help its manufacturers move production out of China and into Japan or Southeast Asia. Filipino consumers are also less upbeat this second quarter and for the rest of the year. That's, of course, amid this ongoing COVID-19 pandemic. This is according to the Bangko Central's latest consumer expectation survey. Now, what did that survey show? You can see on your screens here, consumer outlook fell to 9.2% for the second quarter. That's from 15.7% in the fourth quarter of last year. And the same goes for the next 12 months. Now, this survey cited rising prices and household expenses, low or no increase in income, natural calamities, and the virus outbreak for, of course, a very negative or less cheery outlook. Now, the spending outlook among consumers also dampened for the second quarter at 33%, with more respondents focused on limiting their expenses to medical care and other basic needs. The percentage of households looking to buy big ticket items such as property and motor vehicles in the coming months also saw a decline. While our local economy continues to reel, amidst all of the effects or the unprecedented effects of the COVID-19 pandemic, there's actually one sector that may be hit harder than the rest. And here to share his views on whether this sector will weather the storm, we've got with us Frederick Rara, Senior Research Manager of Saville. Thank you for joining us this morning. Now, sir, recently conducted a survey. KMC Savills is known as a property, specialist, but you're actually doing a survey on all business sectors here. Everything changes on a per hour, per day basis. Tell us what is the latest.
Yes. Well, I think based on our of the last 2 weeks, we're still fairly optimistic on our outlook for the next 2 to 3 months. If you look at the survey, I think 50% of the respondents said that we will go back, back to our daily life on the next 2 to 3 months. But the rest of the 50% is really looking at 6 or more than 12 months of recovery after this. So I think it's fairly well to say that until this time, we're still fairly and really cautiously optimistic.
Okay. Now, sir, is this assuming that there will be a gradual or partial lifting of the Luzon-wide quarantine after, it's slated to end on the end of the month, but there's still some concerns that it might be continued. Do you believe, or do the ones that you've surveyed believe that this is necessary for us to reach what you've mentioned, the 6 to 12 month recovery path?
I think there's really a balancing act here that we can't really gauge until now. So I think that the fair assumption for our respondents is there will be a gradual, opening up of the economy. There will be no hitches, flattening the curve. I think the key challenge here is really just flattening the curve throughout the year, and we just don't hope that nothing bad happens and there's another spike of cases within the next couple of months.
Sir, let's look into each of the sectors in turn. Let's kick off with hospitality, the pinakakawawa. This was the first hit, and it might actually be the last to recover. Initially, we thought it would be a very temporary thing and that we could actually turn to domestic travelers instead. If we orders, we might have domestic travel. What's your outlook now here? And how reliant is the economy on this tourism sector bouncing back?
I think even if we compare ourselves regionally in the tourism sector, we're still a laggard compared to, let's say, Thailand or maybe Vietnam in years. So I think in terms of the chunk of its contribution to the economy, that's still fairly lagging behind our top two, with the remittances and BPO in the BPO sector. So I think moving forward, we won't see that big of an effect, maybe. But then there's a lot of potential here when it comes to, let's say, if you look at the Build program and the resilience of our domestic market. So there's a lot to look forward to, and I think it's just really bad that COVID-19 happened this year.
Sir, what options does this sector have? Because you've got, let's say, retail, they can now tap into deliveries, diba? BPO, they're even doing a lot of technological plays here. But for the hospitality industry, In your experience in past crises in 2008, 2009, how long did it take for people to start spending again on these sort of items, travel, especially when cash is king right now?
I think it was fairly quicker. I would think it was fairly quicker in the previous cycles, wherein there was a lot of monetary stimulus coming in. You would think 12 to 15 months there was a slight rebound already, and then went further after that. Again, this is very different because number one, we have to limit movement on
Mm.
all sectors in the domestic market. And I think what's the response currently is support our efforts with combating the virus. I think there are several hotels already that have refurbished themselves to accommodate the
Okay.
frontliners, maybe even accommodate certain patients also that are positive with COVID-19. But I think that's a very good a shift in the business line. But I think it's a good move.
Okay, so not necessarily for profit, but just pitching in to help the outbreak.
Yes.
Move on to property space. You've been watching this very closely. Now, there's going to be cheaper loans from the BSP, and that actually boosted the property counter on Friday. But tell us, I mean, are people going to be getting more loans here right now in the residential space? Is this actually a good time to be buying into it? Are you seeing a slide in prices, and will this slide, if so, be temporary?
Actually, let's start with addressing the prices. No, it's real estate is really a liquid market. It's not like the equity market or the bond market. It's like every day there's a change in price.
Okay.
Because of that liquidity and the lack of activity in the market, we don't really see any changes in the prices. It's rather a flat line so far. So that's the first maybe several months, and we can't really say where it will go up or go down because of the monetary policy or the fiscal stimulus in place until we get to see maybe a modified quarantine coming in. But in terms of demand, or maybe because of the drop in interest rates, sure, the cost of money is cheaper now, but it's not really for the market to buy more real estate. It's really for the whole real economy. Once the lockdown is done, gets into an environment that's really safe for them to operate and try to get back on its feet. I guess the predominant beneficiary of the really low interest rates is really the real estate market, and uh, I think fair to say that they will benefit once the real economy is up and running.
So, do you have any insight into whether the infrastructure projects might be derailed? And now you've got Vince Dizon of the BCDA saying this might be a possibility. And will this actually affect the property space, directly? And also one more thing in terms of remittances, this is a big chunk of the pie that goes into property investments. How will this all play out?
I think in terms of construction in general, there's really maybe zero activity because of the pandemic, and how this is going to affect infrastructure. It's fairly fair that it will put some delays into the timelines of these projects. But then
Okay.
again, if we look at how the new quarantine measures will be put in place, I think there will be some movement moving forward. And it's not just the labor pool. There's also the supply chain in terms of cement and iron coming in. So there's a lot of factors here, and I think for now we can just say that this most of them will be delayed.
Sir, last question on BPOs, which is now looking to be our saving grace here. Were we actually, in terms of our digital platforms here, in enabling this sector to still thrive with a lockdown? And how would this affect also just the office space in the future?
I think the BPO sector was fairly well prepared for this lockdown. I think for if you compare our operations with your typical BPO company, they're well connected to the internet. You just have to have a stable internet and be in your house, and you can fairly work on it on your daily tasks. I think also in digital infrastructure, they're also well prepared compared to your traditional tenants in the office space. And I think moving forward, they will still be the force for us in terms of real estate that would help us rebound back to our normalcy levels going forward. I think this is the best I think indicators would be the 2009 global financial crisis. I mean, there was a dip in terms of BPO activity, but after that, we were the main drivers for office demand during 2010s and forward.
Okay, so if we learn from the crisis, sir, BPO will be emerging stronger after this is all over. Hopefully, thank you so much. That was, of course, Frederick Rara, Senior Manager of KMC Savills. Thank you, sir, for joining us this morning.
Thank you for having me.
Okay, guys, quick peek on our global equities right now. You can see that overnight we saw a pretty strong showing for Wall Street that is not necessarily spilling over into the rest of Asia Pac. I'm going to be pulling that out for you right now. Now, as of 10:30 a.m., you're going to be seeing Japan in the red. The Nikkei 225 down by 0.9%. And the rest of China and Hong Kong is a very mixed picture here, with the Hang Seng actually up by 0.13%, and Shanghai and Shenzhen as well, but the CSI 300 in the red. So a very mixed picture here, together with our local boards, as I'd already mentioned, in the red. So bucking the uptrend that we're seeing in, for instance, South Korea, and as I mentioned, Hong Kong. Now, recall that China had reported the first economic contraction. That was on Friday. This was the first contraction they'd seen in decades. And also a lot of futures in the US, for instance, the S&P futures that are trading right now in Asia are looking a bit downish. So that's down by 0.7%, even as we have some positive news in terms of the COVID-19 outbreak pandemic. For instance, in New York, they're saying that they might be past the high point of coronavirus deaths. But still, there is one very worrying indicator here, and I'm going to try and pull that out for you. That is, of course, our oil, and how that has slid quite dramatically. Oh, wow. It's 15.44 a dollar for the WTI. That is dramatic. And that is after having dropped to $17 per barrel level, which was already the lowest in 18 years. And this, of course, amid global demand crunches and oversupplies that they had. So again, a very staggering figure here, $15.44 to a barrel for oil. And this is definitely something that, shows signs of very, very strong weakness in the global economy. Now, let's go back to our local markets and try and close with that and see how we are actually trading. Not looking too good. We're actually still sliding close enough to the 5,700 levels, down 1%. And let's take a quick check on our equities here and look at some stock-specific movements. You're going to be seeing some bright spots nevertheless, but nothing like we've seen last week in terms of rallies. Bloomberry, for instance, up by, more than 2%. Pure Gold as well, closing in on those gains. But you've got the property space. I had already mentioned that slumping or dragging down the index. SM Prime, for instance, down by close to 3%, together with BWorld down by 1.8%. Another laggard this morning is Ayala Corporation. I have some strands on that. I'm going to try and pull that out for you. Ayala Corporation has said that they will now be consolidating their power, water, and infrastructure arms into a holding company, and they're going to be growing their energy unit to 1,500 megawatts by 2020. Now, just a quick peek on how that stock is performing and what their plans are there. So what they're going to be doing is integrating the infrastructure program or platform under AC Energy Philippines and its unlisted unit AC Infrastructure Holding. So that's going to be AC Energy, Manila Water, and AC Infrastructure now under one unit, and they're going to be using the AC Energy as the vehicle. I just want to do a quick check on the AC Energy PH unit and how that is actually performing amid the fact that the parent company is slumping. Take a look at that, up by 4.2%. So apart from the fact that it's now just housing, some assets that it had bought from Finma Energy, it's now also going to be the vehicle for the infrastructure program of Ayala, as well as the Manila Water part of the parent company, which of course we know was partly sold to Enrique Razon. They have also mentioned And this from COO Fernando Zobel de Ayala, that they will continue to invest significantly in the water sector to ensure long-term water sustainability and reliability. So definitely not letting go of Manila Water. In fact, the shareholders had recently approved a hike in authorized capital stock to 4.4 billion pesos. For, this was in anticipation of the Razon entry. So I just want to end with a very quick peek here on what Manila Water is trading like. Recall that this stock has seen so much woes due to regulatory issues. It was then bought out partially by Enrique Razon. It's not necessarily seeing the light of day this morning, together with the local bourse down by 0.5%. So again, one stock to be watching out for the rest of the trading day, Ayala's energy unit, as they integrate the water and infrastructure into that holding company. And that's a first look into the business day this Monday. Today's April 20, 2020. Thank you so much for watching. Catch us again tomorrow, 10:30 a.m. I'm Danny Laurel, and we are One News.